In February of 2026, something happened in the Middle East that didn't just rattle markets, it completely tore up the old rule book for global risk. So if you're a financial leader, a chief risk officer, listen up. The playbooks you've been using, they're now pretty much obsolete. We need to look at this new reality.
Okay, so the first thing we all have to get our heads around is that this isn't some conventional war that's just contained by geography. As S&P Global Ratings points out here, it's hybrid warfare. The battlefield is both physical and digital. And you know what? That cyber front has absolutely no borders. And that brings us to the real question, the one that should keep every risk executive up at night. What happens when this new normal isn't just a skirmish, but an event that paralyzes the entire global economy? The stakes, well, they just couldn't be higher. So let's start with the first piece of this new risk puzzle, the cyber front. Because, long before any physical supply chains were hit, the very first shots in this conflict were fired through fiber optic cables.
So what exactly is hybrid warfare? Well, think of it as this seamless blend of traditional military strikes with sophisticated state-sponsored cyber attacks. The goal isn't just to win on a physical battlefield anymore. No, the goal is to create absolute chaos, taking down power grids, financial systems, communication networks, basically to destabilize entire societies from the inside out.
Now, take a look at this. This is where it gets really interesting. Yeah, of course, government entities are the number one target, but look right below that. The second most attacked sector? Financial services. This isn't some far-off theoretical threat. We're talking 31 critical incidents since this whole thing started. It's a direct, ongoing assault on the very heart of the global economy.
Okay, so that's the digital side. Now let's move from the digital to the physical world and see how these things start to compound. The conflict created what you could call the choke point effect, where one single point of failure can basically bring global trade to its knees. And this right here, this illustrates that choke point perfectly. The Strait of Hormuz. It's the artery for more than a fifth of the world's oil. But here's the crazy part. It wasn't shut down by a naval blockade. It was closed by risk. The threat of attacks, of cyber-jamming navigation systems, it got so bad that insurers just pulled their coverage. And when they did that, shippers just stopped sailing. Think about that. The world's oil supply was throttled by an insurance policy.
And the result? Bam! Just like that, 20% of the entire world's liquefied natural gas, or LNG, vanished from the market. A massive producer like Qatar Energy had no choice but to halt production and declare force majeure. This is a supply shock of truly historic proportions. But listen, this choke point effect went way beyond just energy. I mean, the region is a critical supplier for all sorts of global industries. Nearly half the world's urea and ammonia, which you need for fertilizers, for food production, gone. Half the world's sulfur exports, gone. And that's not even mentioning huge supplies of aluminum and helium. And let's just park on that last one for a second. Helium. A full third of the world's supply is now offline. So why does this matter? Because in semiconductor manufacturing, there is no substitute for helium. None. So a regional conflict has just put the entire global chip supply chain in jeopardy.
So you've got this 1-2 punch of cyber attacks and supply chain shocks, and boom, it unleashes this contagion across financial markets. And what happened next? Well, it pretty much broke decades of established risk management theory, because the safe havens, they failed.
For years, we were all told that diversification was our shield. It would protect us. But in the reality of this conflict, that shield just shattered. We saw that dreaded correlation to one phenomenon, that thing that's not supposed to happen, where in a moment of sheer panic, every single asset class moves in the exact same direction, down.
I mean, the scale of the damage was just staggering. In a single trading session, over $15 trillion in value was just wiped out. But why? Why did the supposed safe assets, the ones that are meant to protect you, fall right alongside the risky ones?
The answer is 2 words: forced liquidation. This wasn't about fundamentals. This was a plumbing issue in the market. When investors got those margin calls, they didn't have time to sit around and analyze risk. They sold what they could sell, and they sold it fast. And that meant the most liquid assets, things like gold and government bonds, were dumped first to cover losses everywhere else.
And if you need a smoking gun, here it is. Gold, the ultimate quintessential safe haven, crashed 14% in a single day. It was its worst performance in 43 years, and it happened at the exact moment investors needed its protection the most. It was just a brutal, brutal lesson in how a modern market panic works. And the bleeding didn't stop with that initial shock. We are now stuck in this period of sustained, headline-driven volatility. Every rumor of a ceasefire, every whisper of an escalation, it sends these massive shockwaves through the market. It makes any kind of stable, predictable recovery incredibly difficult to model.
So we've talked markets. Let's shift gears to another huge piece of this puzzle for any risk exec, and that's insurance. Because this conflict didn't just expose a bunch of unmanaged market risk, it created this vast new ocean of uninsurable risk.
And it all comes down to this clause, one that's buried in most commercial and cyber policies, the active war exclusion. Basically, if a loss is due to war, you're not covered. Now, in this new age of hybrid warfare, trying to figure out if a cyber attack was just a crime or a state-sponsored act of war, well, that suddenly becomes a multi-billion-dollar question with no clear answer.
And S&P Global Ratings really nails it here. This creates massive uncertainty for everybody. Businesses thought they were covered for cyber risks, but now they're in this gray zone, potentially facing catastrophic losses with absolutely no safety net. Suddenly, this massive, uninsurable risk just got dumped right onto corporate balance sheets.
So, you add it all up. The hybrid war, the market meltdown, the insurance black hole. What do? Well, one thing's for sure. You need a completely new playbook.
Look at the old way versus the new reality. The old playbook, it's just not going to cut it anymore. That static 10 to 15% allocation to a safe haven, it's useless when the safe havens themselves fail. Instead, your risk models have to be dynamic, adjusting allocations based on the type of conflict. Quarterly rebalancing? You might as well be using a calendar from the 1980s. You need to react to real-time geopolitical intelligence, and that generic advice to stay diversified, it's too simple. It has to be replaced with a whole library of conflict-specific playbooks, ready to go the moment a crisis hits.
Look, what we're talking about here isn't just a bad quarter or a temporary crisis. This is a fundamental, seismic regime shift. We are moving away from an era of easy globalization and into an age of sovereign-led protectionism. And in this new world, national resilience, strategic resources, and real assets like commodities and infrastructure, they become far, far more important.
Which leaves us with one final, and maybe a little uncomfortable question that every risk leader has to ask themselves. After seeing how all these things, hybrid warfare, forced liquidation, insurance gaps, shattered all the old assumptions, you have to look at your own frameworks and ask, are my models built to fight the last war, or are they ready for the next one?